All right, we're about to dive into a financial instrument that honestly sounds like it's straight out of a science fiction movie, but it is very, very real. We're talking about catastrophe bonds.
I mean, just let that sink in for a second. It's a pretty startling idea, right? But it's not an exaggeration. It's the whole idea behind a huge and fast-growing multi-billion-dollar market where investors can make a return based on, say, the wind speed of a hurricane or the magnitude of an earthquake.
So, yeah, how did we even get here? It's a great question, and it really points to a much bigger story. A story about risk, about our changing climate, and about the hunt for profit in some of the most unbelievable places. So let's break down how this whole thing works. And let's be super clear here, this isn't some niche, obscure product. We are talking about a massive financial market. The formal name is catastrophe bonds, but pretty much everyone just calls them cat bonds.
You know, at its core, a cat bond takes the totally unpredictable, destructive force of a natural disaster, all that risk, and it turns it into a tradable asset, something that can literally be bought and sold on the open market.
Now, to really get why these bonds were even invented, we have to look at the system they were built to prop up, and you guessed it, the cracks that were starting to appear in the traditional insurance world. See, the old model was pretty straightforward. You've got your local home insurer. To avoid going completely broke from one single massive event, like a huge hurricane hitting Florida, they would buy their own insurance policy from an even bigger company called a reinsurer. It was just a chain of transferring risk up the ladder. But here's the thing. Those so-called 1-in-100-year storms, well, they started happening a lot more often. The potential damages just skyrocketed into the hundreds of billions of dollars, and the reinsurance companies, they just didn't have enough cash sitting around to cover it all. They desperately needed a new source of capital.
And that brings us to the cat bond itself. This was the ingenious, or maybe kind of ruthless solution that was engineered to solve that cash problem. And it did it by tapping into the giant global capital markets.
So, this is the crucial part. The risk doesn't just move from one insurance company to another anymore. Nope. It gets transferred completely outside of the insurance world and straight onto the books of hedge funds, pension funds, you name it. Okay, let's walk through this step by step. First, an insurer sets up a kind of shell company just to issue these bonds. Second, investors come in and put up the money. Let's say it's $100 million, which is then held in a totally secure account. Third, in exchange for taking on this crazy risk, the insurer pays those investors a really high interest payment. Now, here's the all or nothing part. If that specific predefined disaster actually happens, boom, the investors lose their entire $100 million principal. It goes straight to the insurer to pay claims. But if the bond's term ends and no disaster happened, the investors get their full principal back plus all those nice high-yield interest payments. And these things don't go on forever. A typical lifespan is about 3 years. So for 3 whole years, investors are collecting those sweet, high-yield payments, all while just hoping that a very specific kind of catastrophe doesn't happen. Now, what's really fascinating here is how they decide if a disaster has been triggered. The market is actually moving away from the slow, messy process of counting up actual damages. Instead, they're using what are called parametric triggers. This means if a hurricane's wind speed hits, say, 150 miles per hour at a specific GPS coordinate, the bond pays out. Instantly. It's clean, it's fast, it's just pure data. That speed is a huge deal. But it still begs the question, why on earth would an investor risk losing millions to an earthquake? Well, the answer lies in something that Wall Street considers the absolute holy grail of managing money. The magic phrase is uncorrelated returns. Basically, it means the performance of your cat bond investment has absolutely nothing to do with what the stock market is doing, or interest rates. For a fund managing billions, finding something that doesn't crash when everything else does, well, that's the ultimate form of diversification. It's a true financial safety net. And this just explains it perfectly. Think about it. Financial markets can be in total chaos. Economies can go into recession. But a storm system forming out in the Atlantic, it operates on its own schedule. It couldn't care less about our economic systems. And the same exact thing goes for geology. Tectonic plates shift because of forces deep inside the Earth, not because of a crash on the NASDAQ. So for a huge investor, having an asset that zigs when everything else zags is incredibly valuable for keeping their portfolio balanced. So yeah, we're not talking about small-time investors here. The main buyers are these massive institutional players, pension funds that manage our retirement money, sovereign wealth funds that manage entire national fortunes.
all of them looking for that unique, uncorrelated hedge against total market chaos. Okay, but this is where the story gets even wilder, because the explosive growth of this whole market is tied directly to our changing planet. And that brings up some very serious and really complex questions. And this leads us right into the huge debate around these things. On one side, supporters argue that cat bonds are a vital shock absorber, that instant payout means money for rebuilding is there immediately, not months later. The World Bank even uses them to get rapid relief funds to developing nations. But on the other side, critics are raising a serious moral question. Are we just turning human suffering into a speculative asset that people can gamble on? And there's a huge practical risk too. The financial models that price these bonds, they rely on 100 years of storm data. What happens when climate change makes all that historical data useless? What happens when the 1 in 100-year storm starts happening every 5 years?
So, when you take a step back and look at the big picture, cat bonds are so much more than just some clever financial product. They're a really powerful signal about the world we live in right now. This quote just nails the paradox at the heart of it all. We're faced with a chaotic, unpredictable climate, and Wall Street's response has been to create the most rational, calculated, data-driven tool you could possibly imagine. And honestly, this is the ultimate takeaway. The very fact that a multi-billion-dollar market exists just to trade climate risk is proof. It's the global financial system officially acknowledging that we live on a more dangerous, more unstable planet. This isn't some prediction about the future. It's a financial reality today. It really leaves us with this profound question. When we start creating markets to calculate the exact financial yield of a hurricane, and we mobilize all this speculative capital to bet on disaster, what does that really say about the world we've built?